On September 17th, the Federal Reserve made a move that many investors, analysts, and everyday consumers have been waiting for. After 9 months of holding interest rates steady, the Fed announced a quarter-point cut, lowering its benchmark rate to a range of 4% to 4.25%. This is the first cut since late 2024, and according to officials, it may be the first of several. That decision might sound technical, but it carries ripple effects across the economy, from mortgage rates to credit cards, and even to how businesses think about hiring. The announcement comes at a time when the U.S. economy is showing some mixed signals. Inflation has cooled considerably since its peak in 2022, but it still hasn't returned to the Fed's long-term target of 2%. At the same time, the job market, which had been remarkably resilient, is now showing signs of slowing. In August, the economy added just 22,000 jobs, far below expectations, and the unemployment rate edged up to 4.3%, its highest level since 2021. These developments created pressure on the Fed to act, and the rate cut is intended to give the economy some breathing room. So why does this matter for people outside of Wall Street? The Fed's actions directly affect borrowing costs. When a central bank raises rates, loans become more expensive, and consumers tend to borrow and spend less. When it cuts rates, as it did in September, borrowing becomes cheaper, encouraging spending and investment. Theoretically, this can boost the economy, but can also risk fueling inflation if prices start to rise too quickly. The balancing act between stable prices and strong employment is the Fed's dual mandate, and right now, policymakers are trying to study both sides at once. During his press conference, Chair Jerome Powell explained the reasoning. He noted that while inflation has moved up somewhat this year, the bigger concern is that job growth has slowed. He pointed out that the economy is currently experiencing what he called a low-firing, low-hiring labor market. In other words, while mass layoffs aren't sweeping the economy, new job opportunities are hard to come by. This poses challenges, especially for younger workers, recent graduates, and groups that have historically faced more difficulty in the job market. Powell also addressed questions about consumer credit. He acknowledged that the average FICO score, a key measure of consumer credit health, has slipped slightly this year. While a 2-point decline may not sound dramatic, Powell said it's something worth monitoring. He added that stable prices, a steady labor market, and sustainable growth are the conditions most likely to improve consumer finances over time. Markets reacted in mixed fashion. The Dow Jones Industrial Average ended the day up more than 260 points, while the S/P 500 Nasdaq slipped modestly. Many analysts noted that the quarter-point cut had already been widely expected and priced in, so Wall Street's response was subdued. Still, the decision underscored the Fed's willingness to shift course if economic data continues to weaken. One of the more striking parts of Powell's remarks came when he discussed housing. He reminded the public that while rate cuts can influence mortgage costs, the U.S. faces a deeper structural problem: a shortage of homes across the country. Average 30-year mortgage rates, according to Freddie Mac, were hovering at 6.35% as of early September. Powell suggested that small or moderate rate cuts may not dramatically change affordability in the near term, because the lack of housing supply is a bigger factor than short-term borrowing costs. Another area of focus is inflation. At the moment, headline inflation is running at about 2.9%, while core inflation, which excludes volatile categories like food and energy, is 3.1%. Both numbers are well below the 9.1% peak in 2022, but still above the Fed's comfort zone. According to the central bank's latest projections, inflation may not return to its 2% target until 2028. Powell acknowledged that this timeline is longer than many hoped, but emphasized that the Fed is committed to staying the course. Before we continue, make sure to subscribe if you enjoy clear breakdowns of big economic news. Subscribing helps you stay informed, and it also supports the channel, so we can keep making content like this. An important question is how tariffs and trade policies are affecting the economy. Powell said that tariffs may be playing a role in raising consumer prices and could also be contributing to slower hiring. But he suggested immigration and labor supply issues are likely larger factors. Goods prices have risen more quickly this year, and Powell noted that tariffs are one of several reasons why. However, he emphasized that the central bank's working assumption is that tariff effects are likely to be temporary and not a driver of persistent inflation. For those who follow the Fed closely, the so-called dot plot offered additional insight. 9 officials projected rates between 3.5% and 3.75% in 2025, while 6 expected rates to remain in the 4% to 4.25% range. One forecast was even lower in the high 2% range. Beyond that, officials see interest rates gradually trending lower through 2026 and into the longer run. The divergence among projections reflects the uncertainty of today's economy. And it also highlights that while cuts are expected, the path downward is unlikely to be smooth or guaranteed. The September meeting also drew attention for its dynamics inside the Fed itself. Newly appointed Governor Stephen Moran participated in his first meeting after being confirmed by the Senate just days earlier. He dissented from the decision, arguing for a larger half-point cut. Meanwhile, Governor Lisa Cook also took part after an appeals court allowed her to continue her work while she contests efforts to remove her from a board. Powell declined to comment on Cook's legal situation, saying it would be inappropriate, and emphasized that the Fed remains focused on its economic mandate rather than politics. At this point, the Fed's independence has become a recurring theme. Powell was asked directly whether political pressure has influenced the committee's decision-making, especially given public statements urging aggressive rate cuts. He responded firmly that the central bank's culture is to make decisions strictly on incoming data and economic conditions, not on political considerations. He added that if decisions were being made for political reasons, it would be noticeable in how officials communicate. He stressed that the Fed remains united in pursuing its dual mandate of stable prices and maximum employment. Looking ahead, the possibility of additional cuts later this year is on the table. Economists remain divided over whether there will be 2 or 3 more quarter-point reductions before December. Futures markets are betting on 3, while surveys show the median expectation is for 2. What happens will depend largely on upcoming data, job reports, inflation releases, and consumer spending trends. Each set of numbers has the potential to shift the Fed's calculus. The story of interest rates in recent years has been a dramatic one. From near-zero rates in 2021, the Fed embarked on an aggressive hiking cycle to fight inflation, pushing borrowing costs to their highest levels in more than 2 decades by 2023. Those hikes cooled inflation, but also created challenges for borrowers, from homeowners to small businesses. In late 2024, the Fed began cautiously lowering rates, but then paused for most of 2025 to assess how the economy was absorbing both the earlier hikes and changes in trade policy. Now, with signs of weakening in the labor market, the Fed is signaling that it is once again prepared to provide support. The decision also carries symbolic weight. After months of uncertainty, the September cut represents a pivot, not necessarily toward rapid easing, but toward flexibility. Powell has repeatedly emphasized that the committee is not on a preset course. Every meeting, he says, depends on the latest data. Still, the fact that 2 additional cuts are on the table this year suggests the Fed sees real risks in standing still as growth slows. For everyday households, the impacts will vary. Credit card interest rates, which are tied to short-term borrowing costs, may ease slightly, though not dramatically. Auto loans and personal loans could also become a bit more affordable. Mortgage rates, as Powell cautioned, are influenced by more than just Fed policy, so significant relief may take longer. For savers, Lower rates typically mean lower returns on high-yield savings accounts, though those returns are still higher than they were just a few years ago. At its core, the story is about balance. The Fed is trying to cool inflation without freezing growth, to support employment without reigniting runaway prices. Each move, whether a quarter-point cut or a decision to hold steady, is part of that balancing act. For the public, the key takeaway is not just the headline number, but the Fed's willingness to adjust as conditions evolve. And that evolution is far from over. Inflation remains above target, job creation is slowing, and markets are reacting to every signal. The Fed has laid out its intentions, but the path ahead will depend on countless variables: global trade dynamics, energy prices, consumer demand, and even geopolitical developments. What is certain is that the September cut marks the beginning of a new chapter. Whether it proves to be a short interlude or the start of a longer cycle will only become clear in the months ahead. As Powell himself put it, the Fed is committed to restoring 2% inflation on a sustained basis, while also supporting maximum employment. It is a delicate mission, and one that requires constant recalibration. For now, the quarter-point cut is a signal that the central bank sees more risk in letting the economy weaken than in the possibility of prices heating up again. And for millions of Americans, that decision could shape the cost of borrowing, the pace of hiring, and the direction of growth for years to come. The September announcement, then, is not just a small adjustment to interest rates. It is a reminder of how interconnected the economy is and how decisions made in Washington ripple through every credit card statement, every mortgage payment, and every hiring decision across the country. The story is still unfolding, and all eyes will remain on the data, the Fed's responses, and the broader question of how to sustain both stability and opportunity in a changing economy.